Welcome back. Lecture 4, Day 4, called Sentence to Life, which really just means we're talking about life insurance. Just a fancy way of doing that. Alright, so you get a life sentence here on Earth. I think that's kind of a dour way to say you're alive. And that means death is a terrifying thing, potentially, to you. It's terrifying to many of us. Further, living with a disability can be a challenging and life-altering thing as well. We don't like to think about death. We don't necessarily like to think about disability. However, topics like disability and life insurance sort of feed on that same fear of death and change, right? And they're scary to us because they sort of signify these drastic changes which might possibly someday come to us. So how do you cope with that kind of stress? Well, one strategy to coping with fear is avoidance, right? Just don't even think about it. We talked about this back in the fall, or maybe right now, depending on when you're taking BA 411. We're recalling that stress makes us typically try to not fix the problem, but avoid the problem entirely, right? Like we have these coping mechanisms that deal with the primary issue, and then we have others that deal with the secondary issues, the symptoms, right? And if we choose those secondary emotion-focused coping mechanisms, we tend to not solve the problem that's underneath it all. But again, this is what System 1 sort of drives us to do, because System 2 is exhausted. It's sort of the same logic we have in childhood, right? That if we ignore something, it should probably just go away. Has that ever worked for you? Maybe not so much, right? What kind of problems go away through indifference? Well, sometimes investment problems go away if you ignore them. Not always, though. All right, here's a thought experiment for you. I want you to take a few seconds and just clear your mind out. Okay? Try to stop thinking of everything or anything. Okay, stop thinking about a white bear. Clear that out of your head. Here, I'm going to cross out these white bears. Does that help? Does that make it easier? Okay, stop thinking about these white bears. So what just happened there? What was that? How hard was it to clear out an image of a white bear? Aren't you glad I didn't say something gross? Daniel Wegner identified this concept as ironic rebound. And that means it's hard to put away some kind of intrusive thought that shows up in your head. If you have some kind of fear or, angry, powerful image, whatever in your head, it's really hard to just set that aside and say, get out of here, right? Because the more you focus on it, the more you think about it. Excuse me. So ironic rebound is that practice of trying to push away an unpleasant thought, and it tends to only make those ideas come back. And this effect becomes even worse if you're already tired, stressed, or facing other challenges. So if you've got insomnia, for example, just piles on top of all that, right? Ironic rebound, when you're trying to suppress those fears or negative thoughts, the reason why it's difficult is because there's actually two different neural activities that are going on at the same time. There's what's known as the operator, which is a specific system of your cognition, right? It's a part of your brain that's thinking, and it's actively trying to point your direction away from the thing. So if I say don't think about this white bear over here, the operator is saying, look away, find something else to think about, right? And then there's another system that's involved called the monitor. And that system is checking to see if we're doing the thing we're trying to do. So the operator is saying, think about white elephants or something instead, right? And the monitor is saying, are we thinking about white bears? Are we thinking about white bears? If so, stop, right? So you've got these two processes going on. They're actually pretty intensive. And after a while, the operator, the thing that's saying, think about something else, that thing falls apart, right? Or that thing gets tired, that gets exhausted. That's sort of a system 2 process. And then the monitor is left being checking, white bear, checking, white bear, checking, white bear. So we end up just thinking, white bear, white bear, white bear. I think it's the episode of there's an episode of Black Mirror that's called White Bear, isn't there? I'd say it's a weird episode, but by Black Mirror standards, it's just like a normal episode, right? At the grocery store, the operator might say, avoid buying chocolate. Okay, so the operator is saying, look away, don't look at the chocolate, don't think about the chocolate, think about parsnips. Meanwhile, the monitor is watching to see, are we looking at chocolate, are we looking at chocolate, are we looking at chocolate? right? So we can avoid it. Eventually the operator wears out, right? And it's like, wait, what was I doing here? Oh, and the monitor says, chocolate, chocolate, chocolate. And we're like, oh yeah, that's right, I came here to buy chocolate. So this wouldn't be a problem, except that we tend to believe the things that we think, which is a bigger problem. And if we try to like refuse thoughts and say, no, I'm not going to think about that, not going to think about a white bear, we can become obsessed with them, oddly enough, and make it that much more difficult to get rid of them. Cognitive biases affect us, right? If something comes to mind easily, according to the availability heuristic, we believe that thing is true, right? We talked about that before. It's like the easier it is for something to pop into our heads as part of a category triggered by something, the easier it is for us to believe that that thing is true, right? So speaking of truth, what's true about disability? What's true about your future self? What's true about your life? And what isn't true? Well, time for some slightly macabre surveying. What is the maximum amount of money, let's just say US dollars for my own simplicity, that you would pay to fully guarantee that you do not die this year? How much money would you pay in order to ensure that you don't die? Anywhere from $1 up to $100,000, let's say. Like, what is the price that you would pay to make sure, if you could ensure it, that you would not die this year? Well, one factor in how you answer a question like that is the availability heuristic, right? Like, how quickly does something come up to my head? How readily it comes to mind influences what we believe about a category or a topic. So if we're thinking about COVID, for example, let's say from the distant past, because we're way past it now, or another constantly present threat to your existence, some kind of existential threat, we're probably willing to pay more money to get through the year without having to worry. So if you've seen death recently, right, like, or if you fear for your own mortality, you're probably willing to pay more money to ensure that you don't even have to think about it. Howard Kunruther did some research into insurance and risk, and he found that we tend to only plan for the future according to the information that we have available. Well, that kind of makes sense, right? Like, how do you plan based on information that you don't have? But the problem is we tend to plan better for disasters right after they happen because that's information that we have. But there's a lot of disasters that could happen that we're just not planning for because they do not come readily to mind, right? Like, we plan for the high water marks for floods because we can't imagine there being a greater flood because it's never flooded more than that, right? So the more, we're able to estimate, causes of death on our own, but the more we see these things show up in our minds, right? Like, if we watch media coverage of people dying from a certain disease or a certain accident or something like that, then it becomes more novel or more new to us, right? And more poignant, like we feel it more. System one can't represent reality without bias. Like, it needs these biases, it needs these sort of quick tricks, it needs these familiar things in order to solve problems for us. But that really skews our idea of probability, right? Just because something jumps into system one first does not mean that thing is actually the greatest risk that we have. It just means that's the easiest thing for system one to think of. So another factor in your answer, back to the $1 to $100,000 to not die this year, if you wouldn't even pay $1 to not die this year, then you are a pretty risk-friendly person. Another factor in your answer is the affect heuristic, or the bias, right? Our judgments are always influenced by consultations with our emotions. Like, we can't make judgments without emotions. If the emotional center of your brain is damaged, you will not make rational decisions, right? It's not like emotion and reason are split in your brain. They go together. They work together. So if you're thinking about wanting to stay on this planet, like, if I love somebody and they say, hey, please don't die, and you say, okay, that's very romantic, isn't it? We're also probably willing to pay more money to certainly make it through the next year, right? Like, if my wife says, you better not die on me, or my son says, hey, we got to play Minecraft this year, I'll say, okay, I'll pay a few more bucks to make sure that I'm not willing, or that I won't die this year, right? I'm willing to pay more money to avoid that. Whenever risk comes to mind, it's closely linked to emotional reactions, which, again, is part of our decision-making process, but decisions that are purely based on emotions are also sometimes not the greatest decisions. Paul Slovic actually saw this as another kind of substitution that System 1 makes. Remember, we talked about that in the past, where a lot of times we get asked questions that are too difficult for System 1 to deal with, so instead it substitutes its own question, right? It's like, I substitute my own reality, as Adam Savage used to say. The substitution of what do I think about this instead of that, we say, how do I feel about this, right? Because what I think about this is probably really complicated, but if I have some visceral reaction to it, that feeling comes to mind much quicker. Antonio Damasio found that people's emotional evaluations of outcomes and their bodily states also guide their system, or not just their system one, but also their system two decision making, right? Like how we feel matters to the outcomes of our decisions. And so alongside of all that, because of all that, we likely have a lot of bad beliefs about the future, or incorrect beliefs, or wrong expectations, right? We might just assume like, oh, I'm not going to die until I'm 90, right? Or I'll be healthy until I'm 90. Or I'll have more money to take care of insurance and things like that later. Or nothing bad can happen to me at 20 or 25 or 30 or 35 or 40 or 45 or 50 or 55 because I'm invincible. Wagner discovered that one way to get past these false beliefs is to stop trying. If you give up on that internal control, you get more external control. What does that mean? So stop trying to push those white bears out of your head. Stop trying to fixate on the beliefs, that I'm not going to die. Instead, work on the other side of it, right? When people give themselves permission to express these forbidden thoughts, like I might possibly someday die, they become less primed and less intrusive, and effectively they make us make better decisions, right? They don't control us as much. So here's the truth. Here's the sad truth that we kind of have to face, is that at some point we're going to lose the abilities we have right now. Like the faculties we have, like our brain power, our ability to move, our connections with other people, our work, all this kind of stuff. At some point that stuff's going to go away, right? Unless you die young. We will all likely have people we care about in our lives. That's probably true. I hope that's true of everybody who hears this message. We will all likely die at some point. I'm not saying you're all going to die. Most of us will probably die. Thomas Seaver says we are all either disabled or headed towards it. It's hard to believe, right, that someday I might lose the abilities that I have right now. But if you listen to Sievers, the able body is the myth, right? Not the disabled body. The disabled body is the reality. The idea that I will be able to do all the things I can do right now for the rest of my life forever, that's the myth. Here's a poem by William Carlos Williams called To an Old Jaundiced Woman. O tongue licking the sore on her nether lip, O toppled belly, O passionate cotton stuck with matted hair, Elysian slobber upon the folded handkerchief. I can't die, moaned the old jaundiced woman, rolling her saffron eyeballs. I can't die. I can't die. When we look at old people, we think, oh, they must accept death. They don't want to die any more than the young people do they? They also believe they can't die. After facing the truth, what do we do next? Well, if some disability or death is likely inevitable, what behaviors should you change accordingly, and what actions should you take as a result of that? Well, let's talk about disability. Here's what Social Security calls disability. It says you qualify under the Social Security definition of disability if you cannot do the same work you did after having some kind of accident or illness. The other piece of that is that you cannot readjust your skills because of that medical condition. So you can't retrain, right, for another job. Also, your disability has to have lasted for at least a year, or is expected to last for at least a year, or until you're dead. Pretty stringent. This is the any occupation definition of disability, meaning you cannot do any occupation based on your medical condition. But many private insurance companies don't necessarily use this Social Security definition of disability. So you might qualify for a different kind of disability, even if you don't qualify for Social Security's disability. Insurance companies typically have a broader definition. They use, instead of an all occupation definition, they use an own occupation definition, which means you can qualify as disabled if you're unable to perform the material and substantial duties of your own occupation, right? So if you have a job and that's how you make your money and you can no longer do that job due to a disability, then that's own occupation disability. If you're injured on the job, Social Security might say you could always adjust your skills and do a different job, but your private insurance could potentially pay out if you're no longer able to do the job that you've been doing, if you have it. Modified own occupation means it pays out if you can't do your current job and you can't find another position you're suited for. So somewhere in between those two things, right? So we're going to roll the dice in life a few times, and here's one of the ways that we'll do that. The odds of death or disability, according to Social Security, for males in the U.S. for 2013, you can take a look at this chart over here. Okay. So age 20, the probability of death is pretty low. The probability of disability is very low. But you notice as it goes up, the probability of death rises. Not, at a crazy rate, but it rises. But the rate of disability starts to really increase once you hit 50, right? It really starts to get bigger and bigger and bigger. So by 65, over 26% of this population has, qualifies as having a disability, right? 1 in 4 people. That's a lot of people. And down here you see another chart. This is the odds of death or disability during your working years. And if you're a 20-year-old female, the odds of dying before you're 67 are about 4.5%. If you're a male at that age, death before 67 is about 8.5%, which that to me is sort of scary, right? Like you're twice as likely to die as a male by 67. Guys, what are we doing? What are we doing to our bodies? But the rates of disability before 67 are pretty much equal, right? And it's that same number you see over here. It's about 26, 27%. I don't think we think about that. I think we think like, oh, there's like a 1% chance I'll be disabled by 67. 26 or 27% that you have a disability by 67. That's a big number, right? That's a lot of people. So how many of you are here and how many of you are there? Well, I don't know. A lot of costs involved with disabilities, I'm sure most of you would expect. 40% of Americans could pay their bills or meet their expenses if they were disabled and not able to return to work. And I don't even believe that number. I think that number is too high. I really doubt that 40% of Americans could survive without their work. 44% of American workers have some form of disability insurance coverage. Well, that helps me understand why. It's maybe that 40 and 44% overlap, right? Having disability insurance can make it so that you don't have to worry about what could happen in the future or what will happen in the future, because like Siebers says, we're all running towards disability. It just looks different and it happens differently and at different times. Social Security disability. So Social Security disability is hard to get because remember we already talked about the definition. You basically have to be stuck to get Social Security's disability insurance. Even if you qualify under the definition, you still might not get benefits. Thanks. You must have earned at least 20 credits in the last 10 years. And if you want to figure out what credits are, you can check out this chart over here. But just note that the longer you work and the more hours you work, the more likely you are to qualify for Social Security credits. And the credits can be used to get. Boy, it's like a whole system, isn't it? So study this chart if you're curious. If you're under age 24, you could qualify if you're in 6 credits in the last 3. So I mean, there's ways to qualify, but it's harder than it probably needs to be. It's harder than it seems. Disability insurance, on the other hand, like private disability insurance, if you're not relying on Social Security, you can typically buy through your employer or through the marketplace, and you can get short-term policies. So, for example, if you're thinking like, well, I have maybe a slightly risky job, or else I'm just a risk-averse person, or maybe I have dangerous hobbies, and there's a decent chance I might be out for 3 to 12 months, right, from work. Or maybe I'm at some point in my life, I know I'm going to have this major surgery with this really long recovery time. I'm going to be out maybe 6 months or something. Then you should probably think about buying short-term disability policies. Long-term disability policies are a little bit different because this is something that is for the rest of your life, right? And it doesn't kick in for 6 to 12 months after not being able to work, which means you might need a short-term policy to pay your bills to get you to the long-term policy, which will pay the rest of your bills. Most policies extend from a few years up to age 65. Yeah, they don't really go for the rest of your life, like I was lying to you a moment ago. They go until you're 65 because at that point you can get on Medicare and then the government will pay those bills, which means you will pay those bills. Right? Estimate your coverage needs. So how much insurance you need depends on your occupation, habits, lifestyle, health. Like what do you do for fun, right? Are you a skydiver? Short-term disability insurance could be unnecessary if you have an emergency fund, right? Like, because remember we talked about if you have an emergency fund that's like 3 months of your needs, or even 6 months, that's incredible. That's awesome. But you could probably cover short-term disability out of your own savings if you needed to, without having to necessarily buy a policy for that. Long-term disability insurance, on the other hand, you probably cannot self-insure. Um, Typically, what they say is they take the income that you make and multiply it by 65%. Like, assume you'll need about 65% of your current income um, as sort of an annual disability benefit. Now, what's tricky though is, you remember on that last page we said a lot of these long-term disability policies don't kick in until you hit about 6 months or 12 months of not being able to work. And that time period could be a really difficult time period for you. Can you make it 1 year without income and without insurance benefits? That's going to be pretty tough. And that's where short-term disability might be helpful, to be like, well, here's something that's going to help you until the long term kicks in. That's where that emergency fund pays off. If you can get rid of the elimination period, right? If you can pay for that short-term disability yourself, if you have that 3 to 6 to maybe even 9 months of emergency funds, then you could just get long-term disability. So when should I get insurance at all? It's less about your age and it's more about how much money you have. Like many things in life. As wealth increases, the need for high value disability coverage decreases, right? Because the more money you have, the more you can say, oh wait, I can cover a 3 to 6 to 12 month, issue, and even like potentially years of a problem, depending on how much money I have. So by the time you hit 55, 60, 65, 70, you don't need to buy insurance because you already have the insurance, right? You're going to retire anyway. It's easier to self-insure later on in life. So basically this little chart down here kind of breaks it down. You need more insurance if you have high debt, if you don't have very much money or a big emergency fund, and if you only have one source of income that could easily be lost, right? In that case, you should probably think about insuring because these are risk factors. If you don't have much debt, you have a lot of money, and you have multiple ways of getting income, especially ones that don't rely on you working, like passive income, then it's less likely you need insurance. So for those premiums that you'll be paying, you want to keep in mind, you don't want to pay such a big premium that you have no money. You don't want to be cash poor and insurance rich. The approximate cost of a disability policy you can calculate out for yourself, but if you're healthy and you're working in a low risk occupation, like many of you are, like if you're working at a desk and you're 25, your income times 1% is about the annual premium. So if you're making a $50,000 income, you could probably get a premium that's about $500 a year, which is what, a month, like $40 a month or something like that, which is not that bad, to have a disability policy. If you're not healthy, or if you work at a higher risk job, you got to multiply by a higher value, right? If you're unhealthy and a high risk job, then it's going to be more expensive. But again, if you're unhealthy and you're in a high risk job, that makes it even more likely that you might need that insurance, right? So disability insurance riders, if your insurance is through your work or it's somehow provided from your job, you will typically get cheaper premiums. However, you can lose the coverage if you lose the company, right? So you want to be careful about walking away from a job if you desperately are tied to those insurance benefits. Although that's another sort of conversation on its own, right? Like how much is enough to leave? Work insurance claim benefits received are taxable, so great, right? If you get insurance from your work, make sure you pay your taxes on it. If you buy insurance directly, though, not through your employer, you want to think about getting these riders in there. The first one is a guaranteed renewability provision, and that means they cannot cancel the policy on you. You can always renew the policy, and you want that because they can say, oh, you got cancer this year? Oh, okay, we are out, right? You don't want any of that. Cost of living adjustment you also want because it turns out inflation happens, right? Value changes over time, and if you're getting the same benefit in the future as you are today, well, in the future it's worth less money, right? Also, just a reminder, some of these things are not taxable. There's other riders you might get, but those are the big ones to look for. Workers' compensation is a thing. It does exist. It can provide benefits if you become ill or injured as a result of your work. Employers pay into this fund, you don't pay into it. Disability insurance is much broader though because it's not just linked to on-the-job injury. So it's like if you're involved in a car crash while you're not at fault and you're driving like a company vehicle on your job and you become disabled as a result of that, you're probably going to get some workers' comp out of that. If you are just driving and you get into a wreck and then you get a disability as a result of that, workers' compensation doesn't have anything to do with that. It's a little more limited, don't rely on it. That's why you might want to consider having insurance as well. So, talking about risk a little more. We talked about risk some last time, back in 412, especially, and talking about risk with investments. This is kind of the other side of risk, right? Like there's the risk and insurance sort of spectrum. It's like how much risk is enough, how much risk do I have? And then how much insurance is enough? How much insurance do I have? You have no fear of bad consequences that can lead you into problems, right? The affect heuristic or the affect bias is always something that's working, right? System one, system again, something that readily comes to mind. When we like something, right? So affect is related to emotion. So if we have an emotional attachment to something, if we enjoy something, we like something, then we tend to only see the good things about it and not the risks. It's kind of like when you fall in love for the first time, right? Like you only see the good things about this person. You're just like, oh, this person is a magical angel who I love completely and fully. And I'm going to ignore these like 25 red flags that everybody else is warning me about, right? We only see the good things. System one is interested in things being coherent. It says, no, a person cannot be complicated. A person can't be good and bad. Therefore, my beloved is simply good and perfect. Maybe. In one study, subjects were given information about the benefits of new technology, but they were not told about the risks. After hearing all the benefits of this tech, people decided that there were no risks at all, right? And the other way around too. When people were like really told, lots of information about the risks involved in technology, that's all they could see. Like we tend to only see what we feel. If we feel like something's risky, we only see the bad things about it. If we feel like something is incredible, we only see those good qualities. Jonathan Haidt describes this as the emotional tail wagging the dog, right? Like our whole self is driven by this emotional reaction to things. The affect heuristic makes it a little bit too easy to do that. Timur Kuran studied something called the availability cascade, and that is how these biases that we have and these emotional like affect heuristics that we function under create public policy. Availability is influential. So any significance of an idea, the significance that an idea has is tied to how easy, how fluent, how easy it is to recall it, and how emotional it is when we recall it, right? We talked about that. We talked about the availability heuristic. Like how easy is it for me to recall something? And the more easy it is, the more I think that thing is representative of what I'm talking about. It works the same way with emotions, right? The availability cascade is this self-sustaining chain, and it doesn't just happen for individuals. It sort of works on our society's system one as well as our own individual one. For example, you think about the media, covering an event, like something happens, right? Something shows up in the news, media talks about it, it's usually not that big of a deal. Public panic results from whatever this is. Like the news says, oh, somebody found, marijuana edibles in some kids like Halloween candy or something, right? And the public panic is like, wow, no more Halloween candy, no more children. And the government action intervenes, and the legislators say, like, we're going to make a law that says you can't go door to door. That's my legislator voice, to give people candy anymore. And then the media, does the same thing. It runs a story to try to effectively scare people because it's just trying to drum up viewership. And then everybody does get scared because we're all sheeple, right? And then we get an emotional reaction that shapes the news story. So now the media is covering the result of their coverage. They say, oh, people in the city are whipped into a frenzy over fears about the Halloween candy. And then public concern says, wow, everybody in the city's freaking out. People are interesting. So anyway, bottom line is, just because something comes to mind readily does not mean that it's the right answer. Just because you're afraid of something doesn't mean you should buy insurance. Just because you're not afraid of something does not mean you should not buy insurance. And another piece of this is not just the disability side of things, but also the life insurance, right? Like what happens if you die? Like what happens to the people in your life? Well, they'll be sad, for one thing. Unless you're a real bad person, then maybe they won't be sad. But I know you guys. You're fundamentally solid people. People can be sad when you pass. I guarantee it. Let's take a weird turn. Life insurance provides a tax-free lump sum insurance benefit that can pay for final expenses. Final expenses, it's like what you pay when you leave the university. It can pay for burial costs, debts, other expenses. So what kind of media event or non-event would it take to get you to buy life insurance? What kind of availability cascade would create a situation where you buy life insurance? So here's some of the basics. A policy owner is the person paying the premiums, makes sense. The insured is the person who has to die for the policy to pay off. Okay, makes sense. Usually the policy owner is the insured person, right? Like if I bought it for myself, I'm the owner and I'm the insured person. And then there's the insurable interest, which means if you insure somebody else, you have to show why you're insuring them for one thing. So I can't insure Bill Gates and then, whoops, he died in a weird sailing accident. I guess I get a bunch of money, right? Like I can insure my wife because I can show that, oh, without her in my life, I would be very sad, but also, poor. And there's also usually a beneficiary, whoever receives the policy death benefit. So maybe my son would get the benefit if I died or something like that. There's also contingent beneficiary, which is, if somebody who is supposed to get the death benefit is dead before the policy owner dies, then the next person gets it, right? So if the king has a policy and the prince dies before the king, then maybe there's, baby prince who gets it or something. So the first type you should know about is term life insurance. This is the most common one. This is the one that you would probably be looking at if you were going to look at life insurance. It only gives you a death benefit if you die before reaching a certain age, and it just provides the face value of the policy. So if you buy a $100,000 policy, that's the amount that you get, even though it's way down the road, and that's not worth as much money now in the future. The beneficiary only gets paid if you die within the policy term, which could be a 1-year term, or it could be a 30-year term, or whatever. Usually you want to get an annual renewable term because typically we don't expect to specifically die in 1 year, like we would get one that would renew until we did die. And then usually, a lot of the common level terms are about 5 to 30 years. It just depends on, how much time you think you have left, how much time you want to pay to insure. Because that's the other thing too, is if you have children and you're 35, and if you have young children, you might want to really be insured because they need your money. But if you're 85 and your kids are 50 or 55, they can probably take care of themselves at that point, right? Term insurance is cheap, but you have to be able to qualify for it, so you need to be in decent health. And also you might get it as an offer upon employment. And if you do, you might really consider getting it because usually it's really cheap for what it is if you are relatively young and relatively healthy. The cost of long-term life insurance is at 30 years old, you can get a 20-year, $100,000 policy for $150 a year. That's not that expensive, right? That's like 10 or 15 bucks a month. But it's probably because you don't have any reason to pass money on at age 30 unless you've got young kids. At 50 years old, you can get a 20-year policy for $100,000 for about $600 a year, right? So it costs about 4 times as much. Still might be worth getting, just know that the price goes up because your chances of dying goes up. Endorsements you might want to add on there. You might want to add a disability waiver to that. It'll be paid out if you become disabled. Convertibility provision. This allows you to convert to a cash-only policy. Cash value policy. We'll talk about those shortly. Don't worry about it now. Also, you probably want a guaranteed renewability provision, which, like we said with the disability insurance, allows you to keep extending your policy out without a medical exam, which means even if, again, you get cancer, you still have your life insurance. Because if they have the option to say, oh, you have cancer? No, we'd rather not insure you, right? Because it's just a greater likelihood that you die. Not that cancer always kills you, but it can definitely do some damage. If you have a pre-existing medical condition, if you have a disabled child or child with disability, or if you have some other complicated family situation, then term life insurance is probably a good value for most people. However, if one of those situations is part of your life, you might look at a cash value life insurance. It's a little bit more complicated, and it basically combines a term life insurance with a savings option. So it grows in cash value. It's not just the $100,000 face value is $100,000 now, and it's $100,000 in 20 years. In this case, the cash value grows, and it grows tax deferred, so it is sort of an investment vehicle in a way. You can borrow against that account as well. It's almost starting like a Roth IRA or something almost, right? We can borrow the principal, we can grow that money tax deferred. The benefits paid out to your beneficiary are paid out tax free. Well, that's nice too, right? So again, this is sort of cash value life insurance. It's more expensive, but it's more like an investment. And term life insurance is really more like insurance. The pros of a cash value life insurance is it becomes a way to force yourself to save money effectively, right? It's kind of an investment. And you're able to borrow the cash value within, you know, that fund without getting your credit checked, without having to go through another institution or whatever, right? So it is kind of a way to loan yourself money in some ways. It's also possible to cancel the policy and get the cash that has sort of been stored up in there or grown, but you might have to pay taxes on that. The way that you might use it is you might use it to shelter money in tax advantaged accounts. So if you just have so much money you don't know what you're doing with it, maybe you should put it in one of these funds. They can also provide like a lifetime, coverage or help to somebody who maybe is in your family or somebody that has a disability. They can also provide the ability to leave money to charities or to family members tax-free. So that's an advantage too, right? It's a way of sort of giving a gift. Again, this is something that's probably pretty far down the road for most of you, definitely for me. And they help preserve your insurability, right? In case you lose your health. Like you have the fund, you don't have to keep sort of getting tested or something, right? And then it can give you some kind of liquidity because again you can borrow against the fund, so you can get money out of it if you need to. So if you're rich and all your money is tied up in like foreign bonds and stuff, cash value life insurance plan might be how you get your lunch money sometimes. That's the weird thing about being rich, and that's why you're so rich you don't even have any cash, right? All your money is just numbers on a computer screen. The cons of a cash value life insurance is that they cost much more than similar value term policies. Like, for example, term life policy might cost 100 grand, right? It might give you 100 grand for $300 a year, let's say. And the same one for cash value would probably cost you $2,000 to $5,000 a year, right? But again, it's because you're storing up the money in it. You're not just saying, oh, I got to pay out if I die. There's more to it than that. Also, if you cancel the policy, you might face penalties, which involves losing more money, right? Cash value policy options, you basically have 4 different options here. There's whole life insurance, which is where you earn this fixed rate of return, right? It's like an investment again. But again, I think there's better investments if you're looking at a pure investment vehicle. Universal life insurance pays higher return than whole life insurance for that cash value portion. But again, it's going to cost you more money. It does allow you to skip future premiums. Well, that's kind of fun. And adjust the face value of it. So it's sort of more flexible in some ways. There's also variable life insurance. You can take that money, put it in mutual funds. You can really make it like an investment vehicle. And there's variable universal life insurance, which allows you to invest in more risky products than mutual funds if you've got enough money in there. So these are problems of being wealthy, right? Like you can deal with these problems when you're rich. That was complicated. Do you need life insurance? That's the basic question, right? Well, do you have a spouse or a child? Do you have debts that would need to be paid if you died? Do you want to leave an inheritance or a gift for somebody? Will survivors need money to pay for your funeral costs? Will your health deteriorate in the future? Will you have large tax liabilities at death? I mean, all those questions, if you answer yes to them, you might want to consider getting life insurance at some point because somebody's going to have to pay for that stuff, right? If none of that stuff applies to you and you're still offered some cheap life insurance through your employer, you still might want to take it because it's really cheap. And also because when it's initially offered, you can't be denied because of medical conditions. And the premiums tend to be pretty low because they're negotiated for the entire organization typically. They'll offer usually some kind of baseline level of coverage, maybe like $5,000 or $10,000 policy for no charge to you or very little charge. So you might get one whether you not want one or not. The more of these choices you make, the higher your premiums will cost. Choices like smoking or using drugs will raise the premiums, taking part in risky activities, working as a pilot or a scuba diver, getting speeding tickets, buying insurance when you're older, being male. Stop being male. How much is enough? Well, you can do a lot of math. We're not going to do math. How much is a human life worth? Oof. It's one of those oof questions, right? The answer to the question is, it depends, right? It depends on your estate. It depends on, your family situation. It depends on how liquid your money is. It depends on your debts and all this kind of stuff. So you can do these calculations if you want, but let's not. It's hard to think about hard things, right? Especially math. But there's a few things you can practice. Remember, don't believe everything you think. Don't ignore everything you fear, right? Just because something's coming to mind readily does not mean it's true or correct or good or helpful. And when you feel something bad, don't try to forget it or push it away immediately. Consider why it's new and familiar and feeling bad. And if it's not new, I've thought this before, I've thought these dark thoughts before, it's probably not that important, honestly, if they just keep drifting through your mind. So change gears, focus on how you feel, how you're breathing. Maybe don't try so hard to like push on those intrusive thoughts and let them kind of float around, right? Like little clouds in your brain. Here's a hard question. Does dieting make you lose weight? The answer is sadly no. Then why do we do it? Well, the more we restrict our foods, the more we crave these foods, right? In a study, people were told to suppress their thoughts of chocolate and were on a diet, actually ended up eating more chocolate. But those people were told, don't worry about it. And here's some candy to carry around with you, actually ate less candy. So maybe it's not so much about pushing things out of your head and pushing off scary things like death and disability. Instead, it's about sort of digesting those things and thinking like, why am I thinking about this thing? Is there something I can do about it? Is there a solution? If you're struggling with the daily stuff or with the planning and the future stuff, notice when you're thinking about quitting, try to accept that thought or feeling instead of trying to shove it away. And then tell yourself that maybe all my thoughts are not a choice. Sometimes this stuff just happens. And remember, reconnect yourself to your overall goals and maybe substitute something a little bit more fun, like, I don't know, eating candy bars. All right, that's all for this week. Go read Gulliver Travels. I'll talk to you next time.